Good afternoon, everyone. Welcome to Barometer Readings this Tuesday, July 15th. David Burrows is away today, so James and I, as usual, will give you an update as to what we see driving markets right now and how we are positioned. I will give you a macro overview and discuss market internals. I'm the short-term girl, I'm head of trading, and so I will be discussing some of the catalysts that we're watching right now. And with me is James Callahan, portfolio manager, and he will go through the portfolio positioning and some select names that he would like to highlight. At the end, we will take some questions. So if you have some, please don't hesitate to type your questions into this Zoom chat at the bottom of your screen. So let's begin. Markets last week were pretty flat. Equities were down between 20 and 60 beeps, with the Russell 2000, the small cap market, down more, 1.26%. People are flocking to safe growth, large cap companies. And there's another element, as you have seen year to date, global markets have done very well this year, as the US dollar has lost about 7% of its value relative to other currencies. Some of the US large caps are really international in nature, global in nature. The multinationals, buying a multinational US company is actually buying global growth. So they really benefited for those people that do not have access to, say, direct international markets. Some of these large caps do provide global exposure. And so if you're looking to explain why the small cap domestics have not worked, especially in this age of Trump, who is trying to elevate and support U.S. domestic production on all levels, and why it hasn't worked. This is why, as money flows have flown to anything that's international in nature. Fixed income was also flat, with rates moving within their regular bands, despite a lot of talk about the extra deficit Trump's big, beautiful bill is going to cost. Offset, of course, by tariffs, also a moving target. The only thing that's known is that it's still unknown. Commodities have been very volatile, with copper in the hairs of 50% tariffs, which was surprising. 25% was expected. Oil trying to figure out whether to trade geopolitically or whether to trade on regular demand-supply dynamics. Those being that demand is okay, but is it waning because Trump imposing tariffs will slow growth in America, but also globally? And the market is very well supplied, with oil flowing from everywhere, really. And from a geopolitical perspective, unless there are delivery issues, namely supply disruptions, i.e., the unavailability of the Strait of Hormuz, for example, the oil market just trades on its own supply-demand metrics. The companies we own in the portfolios that are oil-related are now less tethered to the price of oil than before. They are mature companies. In the past, if you said a mature oil company, that was not an attractive thing. But now these companies are free cash flow driven rather than production growth driven. And what this means is that they are great large companies, mature companies with strong balance sheet, focus on proper corporate metrics, throwing off a lot of free cash flow, initiating and raising dividends, and initiating great stock buybacks. So your regular large cap oil company is now a different animal than it was before. It's a lot more disciplined. Bitcoin last week closed at $117,000, and yesterday it traded above 122,000. Breaking out from a technical perspective, it measures quite high, probably 160,000-ish. As we enter crypto week, I don't normally talk about crypto, but I'll explain in a bit why I'm mentioning it here. This week, regulators in Washington are trying to figure out how to ring fence Bitcoin, how to regulate it, how to manage it. This, instead of being a bad thing, means that Bitcoin is being legitimized at the highest level of government. And market regulators are allowing the launching of various crypto ETFs so that institutional investors, as well as retail or all kinds of investors, can have easier and more liquid access to this asset class that is growing in demand on all kinds of buyer levels, institutional included. Now, Bitcoin traditionally traded as a meme stock, let's say, or tended to be a risk-on type of trade. Short-term traders were the ones that were trading them back and forth on different, software-based trading platforms. But lately, it feels like Bitcoin has been trading as a hedge, both domestic, North American, but as well as global, amid all the headlines and the uncertainty, and definitely the lack of ability to forecast due to the many moving parts, and undoubtedly the many unintended consequences, which we likely won't know until we see them in the rearview mirror, that are driven from, of course, the new American administration that is changing the world trade order that we've known since Second World War, really. Our macro fund has some exposure to this asset class. The US index was uneventful last week as well. Today it rallied about 55 beeps, which is a lot for a currency index. The US dollar has lost over 7% of its value year to date, largely due to concerns around the US deficit and other items. This week's market drivers. So what are we looking for this week? It's already Tuesday, but it's been already pretty busy. The market, from my perspective, will be divided into two buckets. Macro, and we got CPI today, PPI tomorrow, and retail sales on Thursday, all very important data points. CPI today was as expected, more or less, with a 2.6% number in the US and 1.9% in Canada. Last week, Canadian payroll numbers came in, and while they're usually volatile, it's a volatile series, it was incredibly good. Canada added 86,000 new jobs, although about 60,000 were part-time, but still zero job growth was expected, and the unemployment rate in Canada went from 7.1 to 6.9%. A pretty big move in the right direction. And, you know, maybe it's the Buy Canada trade that's going on. What's been going on with changing winds has been an increase in domestic patriotism. Perhaps we're seeing Canadian companies benefiting from this trend and needed to hire. So pretty big move, but this likely keeps the Bank of Canada on hold for now, with no further rate cuts right now. It's not expected that they will cut. They will probably hold for a bit and see where things are. The market is, from a macro perspective, constantly shifting narrative between what I wrote on the table in front of you. We call it taco or tart. Are we trading taco? Trump always chickens out is what it stands for, meaning he threatens big and then negotiates it away or delays it. Or is it tart? Trump always raises tariffs, which would be a negative twist. For now, the market seems to be taking this in stride. We've seen headlines of 35% on Canada, 30% on Mexico, 30% on the EU, which is a very big deal because the trade between EU and America is pretty big. And the market has kind of ignored it, thinking that they're negotiating and these high tariffs will be negotiated away, as well as with Canada and Mexico. Plus, we have the USMCA for now. Then we have bucket number two, which is earnings. It is earnings season and it started today. Markets are often trendless during earnings season, mainly because correlations break down as each company reports its own earnings and trades on its own individual news flow, less affected by all the different things that are going on around the earnings. So why were markets so flat last week? As we were waiting for this. Like I said, it's because we were waiting for earnings season and all the different macro data points that we're getting, which do give us a glimpse into inflation or no inflation, which is what kind of differentiates and divides people in this market. Those that think that the new world order is going to create huge amount of inflation. And so we keep waiting for these data points to either deny or confirm that view, and whether the US Federal Reserve, the central bank, will finally cut rates or not. They are the only ones that have not cut as much as the rest of the world so far, which is interesting that the US dollar has weakened despite of that to this extent. Some important companies reported today already, like JP Morgan and Wells Fargo. We also get Netflix this week, which we own. We also own JP Morgan, where earnings were in line. Headline EPS beat, driven by trading and investment banking, which is also a good read into BMO and Royal, which we also own, but they are reporting in a few weeks. But from a top-down perspective, here is a chart on quarterly earnings since 2022. As you can see, it encompasses the weakness in earnings in early 23 in the form of negative earnings, which the market priced in a downdraft of 2022, evidence that the market is a forward-looking pricing mechanism. Last quarter, the expectations were for EPS growth of 7%. Instead, the market delivered 12%. This quarter, the market in aggregate is expecting EPS growth of 4%. So I have two observations on that. One, 4% is low, but okay, as long as it's positive. And looking forward, it moves up. Although, you know, even earnings expectations do get to be more accurate as we get closer, as analysts do cut their earnings estimates or raise their estimates closer to the actual date. So as long as it's not negative, that's great. As long as it's positive. Never seen a recession start while earnings growth is positive. But two, it's a low bar to meet and beat. So we'll know by early August where we stand and what the trends have been. Guidance will also matter a lot, although it's what companies do that matter more. But maybe how they feel will give us a glimpse into what they will do going forward. We talk a lot about international, and this is a European earning chart. These earnings have been cut substantially. A lot more value-driven markets outside of US. But remember, as a forward-looking pricing mechanism, markets price in forward-looking sentiments. And this reminds me on the 22 sell-off, and where I showed you earlier in the prior chart that we had the sell-off in 22, and negative earnings showed up in 23. So it kind of feels a little deja vu here. So we continue to recommend that people have 10% of their portfolios in global exposure outside of North America. So talk to your portfolio manager about how we can help you with that. In terms of reporting by date, just so you know how heavy the next couple of weeks are going to be, the majority of earnings will be done by August 1st. So we will have better visibility into the trends, cash flow, margins, earnings growth, and all the guidance in about 2 weeks. What we will be looking for in the next couple of weeks as we go through earnings is a discussion around the changing trade landscape. I'm so tired of using the word tariff, as the devil is in the details, and the street differentiates itself based on calculations around who bears the cost of the tariff, unless such time that Trump's America becomes financially independent, which is what he wants, where local manufacturing is thriving at the right price. If we get there, if he gets there, it'll take some time. So in the meantime, who bears the cost of that? Will it be companies or the consumer? And just as an example, here is a table delineating the difference between the regional Fed business surveys and Goldman Sachs assumptions, and see how different it is. Goldman thinks that the majority of the cost of tariffs will be borne by the consumers as businesses pass the cost forward. The regional Fed business surveys think it will be more balanced. The difference here is nuanced in that if Goldman is right, then companies remain more profitable, whereas if the regional Fed is right, companies' margins may be impacted. And this is something we will be listening for in the company quarterly earnings calls as they come up. Can we be right? I talk about this often. I talk about the sheer inability to make long-term predictions in the best of times, in the most stable of times, but especially nowadays when the only constant is the change. It is highly impossible to know how to calculate scenarios as the goalposts keep being moved around. This has been highly challenging for the street as well. And just as an example, the stock market has rallied higher than 19 out of the 29 smart people that predict the S&P 500. A couple of them already raised their year-end targets, like Goldman and JP Morgan. And this is why we say trade the market you have, not the market that you think you should have. Big deal. A lot of people talking about this is the US debt. One of the buckets I mentioned earlier was the macro bucket, and US debt growth has been incredibly high, but especially since COVID. This really bothers the bond market, and in particular the long bond, which keeps selling off, pushing yields higher and higher. This benefits financials as the spread between short and long widens. A lot of talk about what happens if everybody sells US debt down. Well, of the $37 trillion worth of debt the US has, a little over 8%, a little over 8 trillion, or 21%, is held in the hands of foreigners. This is not as high as the headlines would have you think, but it's high enough that if there was an alternative and they wanted to exit, it would push yields higher and cost the US even more in interest coverage. So we're watching the bond auctions and refinances very carefully. So far, we haven't seen any stresses. We also haven't seen any stresses in the corporate bond market, and spreads are very well behaved and not blowing out or increasing even, which is one of the things we watch when we look for, is the market getting more risky or not? We're watching upgrades and downgrades of corporate debt. So far, okay. In terms of street exposures, gross leverage is still very high relative to net leverage. And while the words are big, all it means is that there is still a lot of people very negative. Because when gross is so high and net is so low, all it means is that there is a lot of shorts out there, making the net low, but the overall exposure, which we call gross, is high. And our internal indicators have turned fairly positive in the market. Stocks have been doing good work since April. So markets are definitely climbing walls of worry, forcing the weaker hands off their shorts. On the same theme, as I mentioned just now, short exposures, that is people selling their stocks in the hope they go down, has been increasing all year, especially in the smaller caps, but also the larger caps in NASDAQ 100. This tells me that there is still a committed buyer out there, as these shorts will have to cover sooner or later. Likewise, as you can see, the higher the S&P gets, the higher the short interest. Again, still dedicated buyers out there. And in other words, definitely not everyone bullish. Because as Buffett likes to say, buy when everybody's afraid. And a lot of people are afraid. Of course, we will turn course if our stocks go beneath the levels where we feel they are no longer in an uptrend or in a relative strength position. Disciplined selling is something we do very well should risks rise. One of the other items that has been in the crosshairs in the last week is the copper rally. especially US copper premium over LME explodes as Trump puts an unexpected 50% tariff on copper imports. US imports over 50% of its copper, has only two smelters. Takes years to build smelters. So this situation will just be more costly for the US. Either way, our exposure is through Freeport, who is mostly US exposed, and we're looking forward to see their earnings in the next couple of weeks. Economic data continues to hold in despite all the disruptive headlines. This is an example. This is continued claims. They moved slightly up, but still well within normal range. Moving forward, looking at GDP, real GDP is also holding up, and this is important as long as people are buying, as long as that means that if they have jobs, we're watching all those important data points. Total credit card spending is also a metric that people watch. That rose and is continuing to do okay. We saw out of the earnings today, JP Morgan, Wells Fargo, their credit card data point was also supportive of this fact. Market expectations of Fed cut are almost zero until at least September. But that is a moving target as well. It really keeps depending on the macroeconomic data. And one of the great things is despite all these headlines and back and forth and worry about the long end of the bond market and foreigners to in the US Treasury market, the volatility in the bond market is low. And this is very important because, and I've mentioned this before, it's not the absolute level of rates that matters to stocks and equity markets. It's the way it gets there. If it gets there too fast and in an not orderly fashion, it really wreaks havoc with equities. But if it's the boiling frog theory, slowly and orderly, equities can handle higher rates, and there's no magic level as to what that level might be. High grade downgrades outpace upgrades. That is just crossed over. That is a data point that we will be watching to see whether it's just a one-time or there's something more to it. It's usually a very early indicator of corporate bond market, but we haven't seen spreads widen at all at this point. This is what I mean, that the bond market doesn't like the large deficit, doesn't like the big, beautiful bill, and 30-year bond yields have been pushing higher, indicating a fear of inflation in a very long-term outlook forward. Canadian 30-year yields have also likewise moved up. And now I'm going to turn this over to James Callahan, and we'll talk a little bit about our portfolios and how we're positioned. Let me pull up our portfolio changes. James Callahan, welcome. Over to you.
Thanks very much, Diana. That was great, and thanks everyone for joining this call. It's always great to join you all. Nice to see some familiar names on the attendee list here. I have a good amount of stuff I want to cover, so I'm going to try and move through it pretty quickly. So beginning with our current positioning, how it's changed over the last little while. I'm going to talk a bit about Q2 earnings reports, which began this morning with JP Morgan. We have the US banks this week. We have GE Aerospace and Netflix later in the week as well, which are important for us. They've worked well in client accounts, so I'm going to touch on that also. And then I'll talk a bit about the Nvidia news that came out last night. So to begin, you can see here our positioning across the firm. Individual accounts may look a bit different than this, but this is generally where we are. Over the course of the last 2 months, we've taken portfolios to a fully invested position as markets rallied and breadth has improved. So there's been plenty of great stocks to buy, plenty to own. Things do feel quite healthy, and it does seem like even though there's been a bit of rotation to begin the month of July, the market's on pretty solid footing here and has some good built-in shock absorbers. So we've sought exposure to cyclically sensitive sectors, and we've sold down our defensive positions to make room, as you can see from this chart. We have a lot of financials exposure in addition to industrials, tech, materials, and energy. So I think we've owned or not owned tech really well over the course of the last year. We carried no tech exposure for a long time when it was clear there were better places to be. And we do think that differentiates us as a manager. You can see the S&P weight for technology is just south of 30%. So that was a pretty drastic underweight, but it was the right call. Now, there are some great names working well in tech again, so we're involved and making some good returns there. So as I said earlier, we're getting into the period of time when U.S. companies report Q2 earnings. We had JP Morgan report this morning, which is an important position for us as ever. They're the leader in U.S. banking, delivered strong results. The stock was off about 1%, which did represent outperformance versus the rest of the banking space today. To quickly go through the report, because JP Morgan is so important to the U.S. economy, given that they touch so much. Net interest income, which is how much the bank makes on the spread between the rate at which they're able to borrow and the rate at which they're able to lend, came just about in line with expectations at $23 billion on the quarter. JP Morgan raised full year net interest income guidance by $1 billion to $95.5 billion for the year. Both equities trading revenue and FIC trading revenue, which stands for fixed income currencies and commodities, beat expectations. Investment banking revenue came in much stronger than expected and defied expectations for a pretty sharp year-over-year decline by delivering year-over-year growth. So this bodes well for Morgan Stanley, which reports tomorrow morning. They're much more levered to investment banking and trading revenue than JP Morgan is. Morgan Stanley is also a position that we hold. So Jamie Dimon, the JP Morgan CEO, he said that the bank saw a weak start to the quarter in investment banking, but that it had a very strong close. So that bodes well for the U.S. economy in general, as capital markets are functioning as intended. So the bank's wealth management business grew 18% year over year. They now manage over $4 trillion. And the bank's card business, as Diana showed a card chart earlier, grew volume 7% year over year, which is a positive economic indicator, especially in the US. Finally, we always like to see this. The bank returned $11 billion to shareholders during the quarter. So $3.9 billion in the form of their dividend and 7.1 in the form of share repurchases. So JP Morgan also just raised their dividend 20% after successfully passing the Federal Reserve systemically important bank stress test at the end of June. So there remains a lot to like. That's still a core holding of ours. So I'll shift focus now to Morgan Stanley. They report tomorrow morning at 7:30. As I said, JP Morgan strong investment banking and trading results during the second quarter. Morgan Stanley should have a good quarter with that as a read through. We're looking for revenue growth of 7%, EPS growth of 8%, trading revenue growth of 11%. And if investment banking revenue growth can be flat or grow just slightly year over year, that will definitely be positively perceived. And their wealth management business should grow about 8%. For us as well this week, we have GE Aerospace and Netflix reporting on Thursday. Both are positions that have worked very well for us. I just want to put these charts up. So GE Aero earnings are going to be important as they are doing an investor day concurrently. They had canceled their investor day that was due to take place mid-June, just after the Air India crash. It appears now that GE Aero engines were not an issue there. The engines on the plane appear to be in perfect working order. So that shouldn't be an issue for GE. Out of that earnings report, we're looking for 17% revenue growth, 20% EPS growth, over 50% free cash flow growth, and continued strong growth in services, which is the largest source of earnings growth for the company. That has been, as part of the services business, they've grown spare part sales and maintenance provision. So we'll be looking for some longer term guidance there as well. And then moving to Netflix, it's been a great winner for us. They've proven themselves to be recession resistant, tariff immune. And this is something we've talked a bit more about lately, and Diana touched on it previously. But they're a notable beneficiary of weaker US dollar. They license content in US dollar. Generally, they pay to produce content in US dollars, but they have a good chunk of foreign revenue. So US dollar depreciation definitely benefits them. For this report, we're looking for Netflix to grow revenue about 16% and for EPS to grow 44%, which is quite good. So I'll just mention it briefly because I do want to wrap up shortly, but a name we've owned very well over the last few years has been Nvidia. We're involved once again. So over the course of the weekend, it broke that the Trump administration planned to allow Nvidia to ship their China-specific GPU called the H20. So this is a GPU that was created specifically to comply with export restrictions. Even so, the Trump administration had blocked its export. Analysts were very quick to take H20 revenue out of their assumptions. Nvidia themselves quickly took H20 revenue out of their guidance. Now, the company appears like they're going to be able to ship these chips, at least for the time being. So that means an incremental $15 billion in China revenue for the company this year, which will come in Q3 and Q4. It sounds like quite a lot, but against the $200 billion in revenue that Nvidia will do this year, it sounds a bit smaller. So anyway, that bodes well for normalization in US-China relations, and that benefits the semi space in general, especially semi names with China exposure. So we'll see. The Trump administration giveth and taketh away, but for now we'll take it. So that's all that I had. I think we'll leave it here. Despite some rotation to start the month away from some momentum exposed names, which did sting us just very slightly, all of our names and themes remain very strong. So we're happy with the way that portfolios are positioned here. And as always, I thank everyone for joining. Dave's going to be back on next week, so we'll be back to regularly scheduled programming. Diana, thanks very much for your insights today, and everyone take care, and please feel free to reach out with any questions. All the best.